Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to do our daily kind of work through Twitter, see what people are sharing on Twitter. Obviously, I'll interject my opinions. It's generally related to three topics: wealth building, financial topics, and/or commodities, because that's where I think the value is. So let's dive in. Let's see what people are talking about, and I'll share my opinions as we go. You want to follow me? It's at finding_finance. And if you want to join our community, finding-value.com, if you need help coming up into this commodity bull market. All right, so let's go down here. Many oil stocks, except for the pure play heavies, are trading below the levels they were at prior to Russia's invasion of Ukraine. Since then, however, balance sheets are cleaned up, and TMX, which is up in Canada, is almost online. We could be seeing 50% plus gains this year by the summer as oil strengthens. That very well could be the case. And I think that the oil stocks of any of the commodities, I think, are the most legit businesses out there because they are cash flowing a bunch of money. And that's really what you want from a business. A business is more or less a entity that protects individuals from being sued and creates businesses that generates cash. I mean that's the whole point of the business is to generate a bunch of cash. And I think oil is probably the best sector for companies that are doing that. Now, as oil firms up here, we could see big gains coming into this summer. And I completely agree with this guy's opinion here. ISO Energy announces another 15 million bought deal private placement. So we might see some volatility being traded around ISO Energy, and it's due to this bought deal private placement. If US income spikes 69%, we'd return to pre-pandemic housing affordability levels. If US home prices fell 41%, we'd return to pre-pandemic affordability. If US mortgage rates fell 4 percentage points, we return to pre pandemic affordability. The thing that I don't understand is why does everyone think that housing must be affordable? I mean, I know when we had a large demographic called the baby boomers come through home buying years, we had a large expansionary phase of real estate where we built a bunch of homes. And the affordability was pretty bad during that time frame with interest rates going up. I see this as almost the same thing. So why does everyone think, and I know he's not necessarily saying this, but why does everybody think that affordability is going to come back to some really cheap level in the middle of a gigantic demographic coming into home buying years? Like that just doesn't make any sense to me. And another thing to keep in mind is what does it cost to build a brand new home? And what does it cost to replace, existing homes? Maybe Americans are just going to get, less rich. I mean, maybe the affordability of homes because of the way that the cost curves are behaving in the new housing market is going to permanently price people out of houses, single family built homes. And over time, maybe less and less people will be in single family homes. I mean, maybe that's just the fact of the case there. Coming down, stocks remain expensive when compared to the long-term median ratio. You can view many more charts like this one in the long-term section. So this is just the commodity to stock ratio, commodity to S&P 500, and there's your average at 4. Generally, we swing from undervalued to overvalued, and then we go all the way up. We swing back to undervalued, and then we just swing back and forth. Right now, I mean, to me, I don't know why this is so obvious to me and to other people. They get so concerned with short-term market movements. If I purchased a bunch in the 50s, 60s, and 70s and rode this up, you're done. You're retired. Like that's all it takes. All it takes is from green circle to red circle, and you've just outperformed Peter Lynch and all these other guys. You just have to ride one wave. And every single time we've had these waves in terms of the ratios here, you've got these gigantic moves. We've never been so expensive in stocks, ever. And we've never been so cheap in commodities, conversely. Now, here's another chart I want to show you guys. Every single time this ratio has moved, we've been in an expansion phase of real estate. Let me show that to you. Okay, let me show it to you. Expansion phase occurred from 70 to 73. We had another late expansionary in the late 70s, and then it fell apart in the early 80s. Another expansionary phase, late 80s, and then it fell apart in 1990 as it went below the average. Then we had a big, huge expansionary phase that occurred from like 1998, 99. That's where the stocks or commodities were cheap, and we went into another expansionary phase. That was 4 consecutive years of record-setting number of units. Look what we just did over here. We've been underbuilt because of this overbuilt scenario and all of the bad loans that went into practice. Everyone and their mom is comparing the affordability to this affordability when this all went bust. That's not coming back. That's gone. This one time buy a house in 2010, 2009, 10, 11, that's history. We're not going to get that again. I don't think it's coming back. Now, every time we had an expansionary phase of real estate, the commodity to stock ratio went up. Late 70s went up. Like, so mid 70s, we peaked with housing builds, peaked with housing builds, peaked with housing builds was right towards the 1990 crash. We peaked again in 2007-8 with that big overbuilding scenario. So commodities, they trade with this expansionary phase of real estate. And some people will say, oh, it's because houses need more, commodities. That's not, in my opinion, the case. It's the demographic coming through home buying years, the demographic having increased spending, buying more stuff, and that's what puts the pressure across commodities as a whole. And the dollar is what weakens. The dollar weakens up here, up here, up here, and up here. That's the data I've got. It's funny because it's true how men do shopping versus how women do shopping. And somebody said, why don't you just go in through here, go around, and then come back out like that? That's obviously more efficient, but guys don't know necessarily where everything is in the store. So if your wife wants you to buy something that's used in baking and you have no idea what that is, you'll probably have to come back and read the signs if the signs are on the front here or something. That's what I'll say. This is how women do shopping. And honestly, guys, I don't even go to the store with my wife ever because when she like goes all around, I'm like, dude, I'm out of here. I don't want to waste my time doing this. So this is 100% true in my experience, at least. Oil and gas is not the only energy. As the market has reminded everyone over the past year, we're breaking out here for uranium energy, UEC, and I'm just using someone else's charting skills here. So we've got a nice little bowl shape and the breakout. New all-time high, and this thing could get cooking. Could get cooking. The hope recession folks need to explain to their followers about residential construction layoffs. The H stands for housing. And all employees, residential building construction. This is something I watch on for data. And when this goes up, generally you don't get a recession. When this goes down, you are more likely to get a recession. And I just don't see at least this data turning over yet. There's no indication that it's turning over at this exact time. So more than likely, since a lot of employees are employed by residential building construction, and when this declines, that's generally where a lot of the unemployment comes from. This is where you get these recessions. We did get a recession here, and there was a decline before it in the early 2000s. We don't have a decline, at least not yet, in this. But there's also a lot of fiscal spending that is going into building a lot of things, and maybe that is what's going to prop this whole thing up. We'll see. But that was residential building construction. That was residential only. Foreclosures from one last perspective. Don't forget there was a moratorium in 2020 and 2021, just saying. The U.S. foreclosures activity increases from 2022, but still below pre-pandemic levels. So this is pre-pandemic of 2019. We're still below that at very low levels of foreclosure filings. This is forced selling. A lot of the times when you get these big crashes, you get a lot of forced selling into the market. Forced selling started to occur in 2007, 2008, 2009, and 2010. It was ramping up dramatically before the crash in 2008. We do not have any type of large forced selling where I can indicate that we're necessarily going to have this gigantic um, recession. There's just no forced selling yet, at least in the housing market. So my auto insurance, exact same cars, no claims, etc., went up 41% this year. I called the insurance people and told them that auto insurance only went up 7.6% according to the BLS. I still have to pay 41% more, but I know in my heart it was only 7.6%. And this is where they are lying to us about these numbers because they're saying that producer price index, premiums for property and casualty insurance, premiums for private passenger auto insurance only went up 7%. No, it didn't. Mine went up more than 7%, and his went up 41%. Mine didn't go up that much, but I know it went up more than 7. Potential bear flag on the 10-year yield unconfirmed at this stage. You can see a big one coming down, and then perhaps this is a bear flag where it might go lower. If that were the case, what we would probably see is an uninversion of the yield curve, a market slowdown, and we would see gold and silver have a pretty big tailwind if that were to go back down. You'd probably see all-time highs in gold easily. Now, is that going to actually occur? I don't know. We'll have to wait and see. San Francisco housing starts come down to 85,000 a month rate in December. Outside of November, 95,000 rate. This is the highest print in more than 1.5 years. Based on our work, anything greater than 80,000 in San Francisco is expansionary. So housing starts are on fire. Unbelievable responsiveness from this market. Twitter, Warren Pies, you can see it moving on up for U.S. new privately owned housing unit starts. And this here is a big deal because as we go up in housing starts, I don't think we've ever had housing starts go up and us enter a recession, ever. So no recession as of yet. And if housing starts continue to go up, I don't think we're going to get a recession. It's going to be inflationary if we continue to build more new homes, put more new loans against it, and we continue to rocket to the upside of housing starts. It will also put a lot of pressure on housing construction employees. And those employees are good because it's going to be inflationary. They get paid. There's more demand, et cetera, et cetera, et cetera. Logan says, now all you can see why I draw these black lines on inventory charts, because I know some of you don't read or listen, but I resorted to coloring book economic tactics. And this here says the number of housing units per capita has never been higher. The fault of housing inflation falls squarely on the Fed and speculation propagandists like Logan. The problem is the housing units per capita is not accurately being reflected in the inventory. Because if this is true, where we built so many homes per capita, then where the heck's the inventory? So Logan is saying there's no inventory. You are wrong. You might be right that there's a greater number of housing units per capita, but there's none of those housing units are being sold. So if some people have multiple homes, they're not selling the multiple homes. So this isn't a valid argument. It's like an argument that maybe a fifth grader would make. Like that's the IQ level and the wisdom, in my opinion. You can't say, well, the number of housing units per capita has never been. It's like, well, where's the inventory? That's like saying we've never produced more corn in history, but every single store that sells corn is out of it. I mean, that's about as easy as it can get. So if every store has no corn, and even though we were producing as much corn per capita, Some people are eating a lot more corn, or they're putting corn in their car as ethanol and burning it in their cars. So it doesn't matter that we're producing more if there's no inventory of it. We're still in a shortage. Via the EIA, here are drilled uncompleted wells. They're called DUCs to end 2023. I added a plot to show the cumulative percentage drawdown from the peak in total American oil basin DUCs from July 2020. Interesting how Neil Brera built into 2023 and now drawing these down. So these are the declines from 2023 onward. Well, sorry, 2020 onward. We had a little bit move on the Rockies up on a percentage basis, but everything is down. And some of these are down 80% in terms of drilled uncompleted wells. Now, what does this look like if we were to chart the drilled uncompleted wells in terms of the total amount? You can see from 2013, we've been drilling, and it's been going up dramatically. This here was, it was, some of this was sustainable for the energy service sector. We fell off a cliff in 2015 and never really came back, even though we were drilling more drilled uncompleted wells. But this here in 2020, we have fallen off a cliff. That is something that is concerning. It's concerning, what I'll say. AMD currently trading at a PE ratio of 1,300. Is this sustainable? And we've got a breakout to the upside. You know what we call this, guys? Call this a bubble. This is what a bubble looks like. This is what a bubble feels like. Price to earnings ratio of 1,300 is obviously not sustainable. And AMD most likely will probably come crashing down at some point. The question is when? I don't know. I don't know when, but it will. Housing starts on solid footing. We had 1.46 million housing starts for December of 2023. That is very good, and it is still expansionary over the average line. Logan said we had the weakest new home sales cycle ever recorded in history in the last decade. Missed sales estimate in 13, 14, 15, and 18. New one-family houses sold United States, and you can see that we are right here, kind of around the average, so to speak. But this was a monster move from 2002. And remember in 2002, that's when all of the commodities took off, is when we had a very large home sales here. Notice that we're still below those home sales. So we are still sluggish in terms of credit expansion from home sales. Patrick says, don't give away your trading advantage so easily. No need to front run anything. Probabilities of a successful move upwards augment above those thick lines. So we can see kind of this line here, the breakout, and then the big move. Breakout, big move, breakout, big move. This is Canadian versus USD, Australian dollar versus USD, and gold and silver mining companies. We haven't broken out yet. We're still moving lower. And I think what's occurring is that interest rates continue to go up, strong dollar, and that could continue to run these lower because of the strong USD. Kevin Bambro, I like this one, guys. He says there's only one reason why people like Bitcoin, because they own it and want to sucker others into making them rich by driving the price higher so they can eventually cash out and use the coins to buy something real. The token itself is nothing without a sucker in the future to sell it to. Makes sense, and I agree. So this guy here, he had crude oil there. I also want to bring up a crude oil chart of how I view crude oil in terms of oil price on the long term. So this is the long-term oil price for crude oil, the oil price. Now, this is how I view it. I see a consolidation with slight up move all the way to 1970, a big monster move higher, which also correlates with that expansionary phase of real estate. I see another sideways motion all the way sideways of consolidation from 1980 all the way to about 2002. 2002, we saw just recently that big move in housing starts, and we had a big blow off breakout move in oil. Now, look what we've got here today. We've got from 2008 all the way to 2020 a consolidation, a three hump consolidation. This was another three hump consolidation here, there, and then the last one's here. So one hump, two hump, and then there's the third hump there. And then we could draw a line going through here. This was wave one move. Up, down was wave one. This wave one move, it broke us through it, and we're coming and doing a retest on top of it. You can even see it has this little like pattern here, which we're basically doing the same type of pattern. So right here is right where we're at today. It's right in this section here. So this was the move up and then the pullback. This was the move up and then the pullback. This bottom here signals this bottom here. And then this move there is this guy there, I think, before we get a big wave three that comes. So I think that we're close to a big move in oil price. And I think we might have just broken out of the downtrend line. So that's where I'm going to end it, guys. Give me a thumb up for the content, subscribe to the channel. And yeah, still bullish on commodities. It's going to take a long time for me to be unbullish because all of the data supports it. And even I see a lot of this data, and I'm not using data that is biased in one way or another. I'm trying to find any data that, biased or unbiased, that has validity to it that would contradict what I'm saying. The ratio charts are cheap. The question is, well, when is it going to, basically appreciate against stocks? It's just a matter of time. And the right market conditions are there for that to occur under in an expansionary phase of real estate. So that's what I've got. We'll catch you guys later. This is Finding Value.